Hey everybody, in this video we're going to be looking at the Chapter 9 homework here. And in this chapter we're going to be looking at inventory primarily and different types of inventory related accounting for merchandising companies. Okay, so we've got in question 1 this business that spent $18,800 to purchase 1,000 shirts as inventory. And so we got some great shirt wholesalers. We bought these. And then Black Star retailers paid $23,800 for the 1,000 shirts from great shirt wholesalers on October 5th. Payment is due in 1 month, and we use both companies use perpetual inventory systems. So this company has you kind of looking at inventory transactions both from the seller perspective and the purchaser perspective, and kind of excuse me, both perspectives as far as it goes from the great shirt wholesalers, because they bought the shirts and then they sold them, and then these guys, the black shirt, bought the material. Okay, so if we are the black shirt retailers on October 5th buying these shirts, we're going to record that in as merchandising inventory, and we paid $23,800. And I'm assuming we're going accounts payable here as far as our credits go. Generally, anytime we're looking at transactions in this chapter, whether it's sales or purchases, we're using either accounts receivable, accounts payable, not cash transactions when it comes to inventory. Okay, so let's see. Prepare the journal entries for great shirt wholesalers. So these are the ones who sold the shirts to Black Shirt. So like I just mentioned, we're going to have accounts receivable and we're going to have sales revenue. So a little different. We've seen service revenue primarily in the past. And so as we can kind of take a look here, you sort of see that this is all, it's two sides of the transaction. This is the sellers and this is the purchaser. This is the customer and the seller here. In this instance. And so here we've got accounts payable that matches up with the accounts receivable. So really it's like two sides of the same transaction, basically just from the perspective of the buyer and the seller. But when it comes to the seller, we also have to do this extra transaction that incorporates the cost of the goods sold. And that number is going to be what they paid for the shirts here. So Great Shirt originally spent the $18,800. And so that cost, that expense that they had to incur to purchase them in order to sell them is cost of goods sold. Or it was inventory until they were sold. Now it's cost of goods sold because these shirts are gone. And so if we wanted to know their gross profit, then we'd have to take $23,800 minus $18,800. So I think that's $5,000, I think, of gross profit then after accounting for the cost of goods sold. Okay, and we got 100% there. Let's move on to the next problem. Okay, so this supermarket bought $3,240 worth of groceries on account from a produce supplier on October 16th, 2024. On the 17th, the bookkeeper was informed that $280 worth of tomatoes were substandard and returned to the supplier. Prepared the journal entry to record the purchase return using the perpetual inventory system. And so, again, that original journal entry would have been merchandise inventory debit and credit accounts payable, kind of like what we just saw in that last problem there. And then we're going to reduce our accounts payable now because we're not going to pay for this $280 of inventory, the tomatoes, and we sent them back to the seller. And so we're basically reducing our accounts payable. Remember, accounts payable, it's a liability, so it increases with a credit. So it would have been $3,240 originally, but now we said, oh, we don't want this portion of the stuff we bought, and so we're going to reduce a piece of that $3,240 for that returned. And we returned the inventory, so that's an asset, credit's a decrease. we don't have that $280 worth anymore because we sent it back. Okay, on December 8th, 2024, Stuff Mart received a shipment of t-shirts from Promo Novelties. Okay, so we were going to pay $2,510, and it was recorded in the accounting system. Soon after the delivery was made, the marketing manager saw that the logo was printed incorrectly, and the goods were returned. So I think this is going to be real similar to the basically the same thing we just did in the other problem. So we're just returning. Is it the whole amount? Maybe. I think it said we just returned the whole amount here in this one. So let's check ourselves. Yep. So same exact accounting. Reduce our payables, reduce our inventory, and in this instance, we return the whole thing, and we're not going to pay them for it essentially. So we don't have the inventory anymore, which is what this is doing, but we also don't have that liability to pay anymore because we returned them, and that's what this debit to the liability reducing it is doing. Okay. Question number 4 says, Bedding for More received a shipment of sheets on June 4th. The value of sheets was $15,000, and the sheets were shipped FOB shipping point. And we haven't really talked about this too much, at least in the class of this semester of which I'm making this video at this point necessarily. So just to highlight it, and maybe if we have talked about it in class in the semester that you're watching this video, reminder that this FOB shipping point is freight on board shipping point, and you can either have shipping point or destination, and the difference between the two indicates when ownership passes. So if we're doing shipping point, then it's going to be owned by the purchaser at the point at which the goods are shipped, as opposed to being owned by the purchaser at the point at which it's received at the Bedding for More, loading dock, for example, in this instance. Okay, so something to just keep in mind when ownership transfers of the inventory. Okay, so we purchased the inventory here. Okay, sorry, I had to pause to get a drink there. Tickle my throat. It's allergy season here in the spring of 2025 when I'm recording this video, so bear with me. I apologize for the excessive coughing. Okay, so back to the problem here. We bought the inventory, so $15,000, and again we have payables associated with the amount to record. Oh, I'm sorry, we got to include our freight charges too. So we had freight as well. Oh, not 12,500, 15,200. And since we were FOB shipping point, it's, like I said earlier, it's our inventory when it's shipped. We're paying the freight is basically what that's alluding to, and the full cost of getting the inventory to us is what we include as the value of the cost and what we had to pay for that inventory essentially. Okay, part B says the bed sheets delivered were the wrong material. Oh shoot. So after some negotiation, the manager agreed to keep the products with an 11% allowance. They spelled that wrong, allowance. Prepared the journal entry on June 19th, 2024 to record the purchase allowance. Assume that all bed sheets are still are still in the inventory. So we didn't send any back. We're just taking an allowance on that amount essentially. So we're going to want to, I got to do my math here on the side. Let me find open an Excel here. Give me one moment. So we're looking at 5,200. And really, here it does say that we're not granting the allowance on the freight charges, basically. So 1,650. And I got that number by taking 11% of the amount, just the 15,000 piece, right? Not the 15,200. because it said no allowance on the freight charges. So again, it's just the same as a return. If we had returned a portion, but we said, oh, okay, this is the wrong material, but since it's a hassle to send it back to the supplier, we're going to just keep it, figure out what to do with it, and then the supplier says, okay, well, we'll give you a reduced price to pay for it because it was the wrong material that they were supposed to send, etc. So, okay, and now finally we're going to make a payment. And here we're getting rid of our payables in total, the remaining payables, think of that there. And then we've got cash going out, right? That's kind of our standard payment there. Okay. And we are going, so we take our 15,200 and then we subtract out the 6. So here's the original increase to our liability for the purchase. Then our debit is going to reduce that liability, and that brings it down to 13,550. That's my math. Let's check ourselves there. Yep, and that's our payment. So you just have to make sure that you go back and update your payables, your amount that you owed for updates, for things like returns or purchase allowances, etc. All right, let's look at problem number 5. And it says the following is written on an invoice relating to goods that were purchased 410 net. It means 410 net 30. So in essence, that means a 4% discount as long as this is paid within 10 days. That's what the first part means, 4% if you pay within 10 days. And this means you have to pay it within 60 days, regardless of when the payment is made. Okay. Excuse me. Okay, question number 6. If a computer company bought computers for $9,000, sold them for $20,000, how much would the gross profit be on the entire shipment if the business took advantage of the early cash payment discount terms of 410 net 30 from the supplier? So the first thing we need to know is what is gross profit, right? So remember that gross profit is sales revenue minus cost of goods sold. And so in our instance here, we would have 20,000 was our sales revenue and 9,000 was our cost of goods sold. So if we just considered gross profit without the anything about the discount, then we're going to have, what is that, 11,000, I believe, 11,000 of gross profit. But it's telling us that we did take advantage of the early terms of the discount, and that discount was 4%. And so we take 4% of the 9,000 because we don't have to pay the full amount, basically, right? We're going to pay 8,640, which is 96% of 9,000, basically. So, taking that 4% out. And so that increases our gross profit from what would be easily, 11,000 to 11,360. In essence, just because we were allowed, because we paid quickly, to pay less for our inventory, and so our cost of goods sold then is lower. All right, question number 7. On February 8th, Food and Stuff wholesalers purchased $2,900 worth of dried fruit, paid $170 for freight charges. Then we're the wholesalers, right? Okay, so then we sold all of this to retail grocers for $4,880 on account, and Food and Stuff uses the perpetual inventory system. Okay, so let's look at February 8th is when we bought the stuff. So again, we've been doing a bunch of these entries so far. So inventory up, accounts payable up, and then we sold the stuff later. Oh, I got to include my, again with the freight. So 2,900 plus 170, that gives us 3,070 total. And then when we sell it on the 5th, we're going to get accounts receivable. We're going to get sales revenue, and that was for 4,880. And this is just all provided to us above, basically, right? And then the cost of goods sold is going to be, the cost that we paid for it, which was the 3070 again. And that's going to be there, 3070. Oops, not cash. That should be COGS. COGS, merchandise, I think that's all in there. Good. Let's check ourselves. Yep, 100% there. So just remember what you paid for the inventory is later what becomes the cost of those goods that you sold, essentially. So hopefully that makes sense. Okay, so now we're here looking at question number 8. So we're a bookkeeper for this wholesaler. Okay, so one of our the purchasers, something we sold, one business we sell to, is unhappy with quality of tables delivered on February 9th, and they're going to ship back all of the goods. The original invoice amounted to $3,000. Cost of goods were $1,200, and so we have to go through and do the accounting here, basically. Okay, and it tells us some additional information down here. It says, rather than taking the tables back, your sales manager agreed to allow Ben's retailers a 10% discount if they agree to keep the goods. And so we're going to record Ben's payment in settlement of the invoice on March 9th, assuming that the allowance is not recorded until the settlement date. So basically they're paying us and the customer is going to be taking a 10% discount, right? So we're getting cash. I think this is our receivables going. Find my receivables. Our receivables is going away. So we always want to have the full amount of the receivable going away when we're talking about discounts of any kind. So AR should be gone, and AR was 3,000. But what's happening here is we're going to use our sales returns and allowances account. Pretty easy math. We're giving them a 10% discount, so they're only going to pay us $2,700 instead of the $3,000 they would have owed us otherwise, because we gave them a 10% discount, basically, right? So how we record the difference, we want to have the 3,000 because AR needs to go away, and AR was 3,000 before we, when we recorded the sale, the sale part, and this is the cash collection part. But the cash that we collect is less than the 3,000, so the difference then gets recorded to this contra revenue account of sales returns and allowances. Okay, so then it says, suppose that we ship back all the goods on February 25th, and the inventory was put back on the sales floor. Wait, so is this a different... Let me understand what's happening. Okay, so this is like a different scenario. I think we're saying instead of us giving them a discount, in this scenario, assume that they just sent it back to us. And so we got the inventory back at that point. And we're going to reduce. All right, here, I want to put so we had, because I kind of like to write these out. The original journal entry to record the sale would have been debit accounts receivable, credit sales revenue, and then debit COGS and credit merchandise inventory. That would have been our original journal entry there. And then we're basically going to kind of reverse our whole deal, except we're going to use, instead of reversing the sales revenue account directly, we're going to use our sales returns and allowances account again. So if we were exactly reversing the entry we originally recorded, we would be debiting sales revenue because the original entry was AR and sales revenue. So, but instead of reversing sales revenue, we're going to debit this contra account again for $3,000, which was the original, sales amount. So what in essence, this will reduce our sales revenue account to bring it down to zero. And then we're going to put the inventory back on our shelves, essentially, right? So we've got a direct reversal, basically, of the original entry for this part. And I think it said it was 1,200. Cool. So we're looking good there. So now the inventory is back on our shelves. Our cost of goods sold has been decreased. So we're not, it's not a cost of good because we didn't actually sell it. They sent it back to us. It's back on the shelves. It can be sold again. And then we've reduced our receivable because they're not going to pay us because for the product because they sent it back to us. And finally, we debit the contra revenue account, sales returns and allowances, to offset the revenue we originally recorded. And that'll bring it down to zero. A revenue to zero when you add those, sales revenues plus sales returns and allowances as an offset. Okay. Part C says, suppose that they ship back half of the goods and kept the other half with a 5% allowance. Okay, now it's tricky. Journalize the transactions, record the sales transaction first. Okay, so half of it came back to us then. Now what are we going to do here? Okay, so let me look at our total. So originally they owed us $3,000. And that cost us $1,200. So when they send half of it back to us, we're going to do like this same entry essentially, right? We're putting the inventory back on our shelves and we're reducing our cost of goods sold by 1/2 of the $1,200 because they sent half of it back. But then we're going to want to do something different. If we had not offered a discount, we would have just done the same entry above here and said 1,500, right? Instead of 3,000. So sales returns and allowances, and then accounts receivable goes down. But the amount that it's going to go down is not the 1,500, but instead, what is it? 1,500 times 0.95. Make sure I've got that going the right way because we're going to reduce it by 1,500. Actually, I think that is going to go the other, but then we're going to reduce it further, not just by half. So it's not that we're not only going to not collect the full amount of the sale because half of it came back, but we're giving them a 5% allowance. So we're going to receive even less. So we're going to say 1,575. So 1,500 is the half that we're not going to receive for this piece that we got back. And then the 75 is a reduction of the other 1,500, the other half that we are going to get paid on, but it's going to be less 5%. We're only going to get 95% of that payment because we gave them a discount basically. So that one's a little confusing. You got to divide it in half, do this kind of entry. And then you got to consider the allowance piece and kind of add those two together to get to the 1,575. Okay, let's take a look at number 9. If sales revenue is $358, cost of goods sold is $196,900. Let's see here. That leaves us with $161,100 of gross profit. Basically just taking 358 minus 160, 358,000 minus 196,900 gets 161,100 of gross profit. And then if we take the 161,100 of gross profit divided by the 358, then we get 45% for our gross profit margin. Okay. Suppose that on September 21st, both company A and B sold inventory with a cost of $33,500. The updated balance of inventory at September 1st was $107,300. Company A uses the perpetual system, and Company B performs an inventory account at each month. What is the value of inventory as of September 21st? So we only do the inventory only updates under the periodic system when they do the count at the end of the month. So what we're saying is we started with 107,300 and then we sold 33,500. And so for the perpetual, it's going to be the 107,300 minus the 33,500 or 7,300. But for the periodic, because we haven't yet done the inventory count, and gone out and looked, and updated inventory at the end of the month, it's still the same balance it was at the beginning because we're only at September 21st. So at the end of September, once we go do the count under the periodic system, if that was our only sale, was this one transaction, then they would be the same. But at this point, since we're talking about September 21st and we haven't done the count yet, we have not yet updated with the periodic system. The perpetual just gets updated every time there's a sale. So that's more of a real-time system. Glue Man. Okay. The following is Glue Man Industries adjusted trial balance. So we've got a whole trial balance here. And what do we want to do? Okay, so we're doing a closing entry here. I'm going to put this into an Excel, just copy and paste it out here. Just bear with me for one moment while I do that. Okay, so I've got these all in my trial balance. And remember, okay, so when we're talking about closing entries, remember that we're going to be closing everything that is a temporary account, which includes revenues, expenses, dividends, anything that's basically like a component of capital or equity. So, and we're going to be using the income summary method, just like we've already learned previously in the previous chapter. So nothing too different here or surprising, hopefully. So remember our REID, we kind of learned that acronym. So revenue is going to be the first one. And basically remember what we do is it's like opposite, right? So we just take the opposite. So if revenue is a credit, which it typically should be, can't have commas, I don't think, for this to work. We just debit sales revenue, for example. Whoops, not unearned revenue, sales revenue. And then we put it to the income summary. Jeez, I cannot select the right thing. So 78,930, and that's just the revenue there. And then we're going to go through and close our expense accounts. So I'm going to can I just paste these in? Doesn't work, shoot, okay. We have to select them one by one, slightly annoying, but that's okay. So sales returns and expense, sales discounts first. So we do sales discounts, sales returns and allowances, cost of goods sold, depreciation expense, rent expense, salaries expense, and utilities expense. And then they're all, expenses are always debits in general. So now we're going to credit them to close them. So I'm just going through and typing these in here. And when we add all those together, which I can do in my Excel I have off to the side, we get 76,885. And that's all going to go again to our income summary. Let me check my math. Okay, that's looking good. And then we can tell that we have a credit to the income summary of 78,930 and a debit of 76,885. And so the difference between those two is 2,045. It's lower on the debit side, so we can kind of tell right away that we need a debit to close the income summary, and the credit is going to go to capital. And there was no dividends in this example or anything, so that's just the revenues and expenses is all we had to close for these ones. So that gets us there. I think the wrinkle on this one, that's different from what we already kind of did before, is just the fact that we're considering some of the new expense accounts like cost of goods sold, sales returns, and these are contra. These aren't expense accounts, actually. I should say they're contra revenue accounts, these two. But they essentially behave the same as an expense account. They're just included in a separate place on the income statement. Which this problem will have us work through. So that's good timing. So here we've got a whole trial balance. Again, I'm going to copy and paste this over, so bear with me again. Okay, so problem number 11 has us again with a trial balance. But like I mentioned, in this problem, we're going to just be preparing the income statement, I think, or all the owner's equity statement and then the balance sheet. So we're going to do all the financial statements here. And so let's get started. Sales revenue, we're just basically taking things down. So 52,700. Then you can see, like I mentioned, this cost of goods sold. And let's see, do we put negatives? Okay, no, so we just put these in as positives, but they are offsets to sales revenue. So these are in a subtraction from the 52,700. Or sorry, cost of goods sold. Yeah, I said that right. So this is a subtraction from this. It just doesn't have us put negative sign on it. So that brings us to 32,700. And then we've got, we're going to break this out into different categories. So selling, administrative, operating expenses, other incomes and expenses, etc. And that's kind of the whole thing about the multi-step income statement. Definitely a big change from, the more simple style that we've done before. Okay, so we have to enter the accounts in the appropriate statement in the order they're presented on the trial balance. Okay, so we're going to put them in. It's just, we're sort of just putting this thing together as a puzzle. If you want to think of it that way, we got depreciation and interest expense is going to go down in other income and expense, I should say. Let's see what else is going to go down here. So gains on sales or loss when we sell equipment or have a loss or a gain on the sale of equipment. That's going to go there. Let's make sure that's in the right order. So gain goes before interest expense. So I think it's not going to like it if we do it that way. So let's change that. And then the administrative expense side, we've got office rent and depreciation. So we've got that came first. And these are more administrative expenses in nature. And the depreciation expense was $2,300, and the rent expense for the office was $5,300. And let's put the numbers in here. The gain was $4,900. The interest expense was $600. Again, this is a plus, this is a minus, but it's telling us not to use negative signs. So anyway, let's see if that all comes out right. So we got 4,900 minus 600 gives us 4,300 for other income is the net amount there. Total administrative expenses then becomes 2,300 plus 5,300. And that's 7,600. And then we've got different selling expenses. And so let's just take a look and go through those. So advertising expense would be one of those, kind of a selling expense, right? You have to advertise your stuff to sell it. We've got rent expense for our retail space. So again, that's where the goods that we're selling is housed. And then we've got, I feel like I'm missing one here because there's an extra space. Advertising, retail space, and sales salaries. What are we missing? Just taking a quick look here, see if I can figure something out. We've got the gain, we have the sales revenue, we've got the cost of goods sold, depreciation expense, we've got there, interest expense, advertising, office salaries. Oh, I guess we had office salaries. So let's put that up here. I guess the depreciation expense is going to be considered a selling expense. That seems a little bit weird to me, but okay. Shoot, that's probably gonna throw us off. This is an annoying problem because we have to get this in the right order. So depreciation expense would be the first one then, I guess, and then let's see what's next. Advertising, and then rent expense, retail space, and finally salaries, sales expense, sales people salaries. Okay, well, let's give this a try. So that's our depreciation, advertising, retail office space, sales salaries expense, and we add all these together. I almost want to do my check before I add them because I'm slightly concerned that this depreciation expense is kind of throwing me off, but I don't know, we'll roll with it for now. Let's see what we get here. So $32,700 of gross profit minus $23,700 of selling expenses minus $7,600 of admin expenses brings us to $1,400 of total operating. So we got to add these together. Adding the two expense categories gets us $31,300, and then subtracting that from gross profit gets us $1,400. And then if we added back in the $4,300 of gain, we're going to end up with what, $5,700, I think. Okay, let's check ourselves because I want to make sure that I don't have something off before we move on. Oh, I didn't change that part of it. Yeah, that should be the rent expense. What comes first, rent expense or salaries for the office? Office salaries and rent expense, office space. Is that right? Office salaries? I think rent expense comes first for the office space and then salaries. That doesn't seem right. No, let me give it a try. Let me do it the other way. It really should be the other way because that's what they're telling us here is do it the order that it's in the trial balance. Oh no, office salary expense is below on the trial. It's the last one, so goofy. Okay, so anyway, our rent expense for the office is $5,300 and office salaries expense is $4,100. And then $5,300 plus $4,100 is $9,400. Okay, $23,700 plus $9,400 then becomes $33,100. Then $32,700. See, once you get one little thing off on these types of problems, they really get wonky. Okay, so then we had a net loss from operations because that income or expenses were a little higher than our income. But then we add back $4,300 and what do we get? $3,900. Let's get that. Whew. All right. Yeah, kind of a wonky problem. So it's a little tricky. It's fine, but you just got to understand. That's the one thing where equipment, I guess that would be, considered a selling expense. That's fine. I mean, it would have been easier if they identified specifically like equipment related to selling, or something like that, as opposed to equipment related to, because it could be like computers or a printer or something. It doesn't really specify if that's administrative or selling. So, and then you got to get it in the right order, which sort of throws things off as well. But looking good. It's enough complaining. Okay, so our capital then, $43,600. We're just going to pull that in here, bring that down, add our net income we just calculated over here. What is draws? 2,000. Remember, that's a negative, even though we're not putting negative signs on. So we get 43,600 plus 3,900 minus 2,000 brings us to 45,500. Oh, that's the total. The subtotal is just these two, which is 900? No, 1900. And then 43,600 plus 1900. I don't know, let's check ourselves. I think that math works, but okay, yeah, that's good. Okay, so remember one thing too is net income, remember, comes down to the statement of owners equity here, and then equity, the capital ending balance, comes down to here, and that amount is what we calculated, 45,500. And then let's just go through and put all our stuff in here. And again, we're doing a classified balance sheet, so we're classifying current assets, non-current assets like property, plant, and equipment, current liabilities, non-current liabilities, etc. So extra classification that we haven't really seen up to this point. So when we're filling out the balance sheet, we always want to put the assets in order of liquidity. And so cash is always going to be number one. And then accounts receivable. And then sometimes I think inventory is going to be, what else do we have? Store equipment. Okay, that's more of an asset. And then prepaids. It's always a little bit, you would kind of need to know. But I think this is going to work for us. If you really wanted to be sure which was more liquid, you'd have to know when these prepaids are going to be used up. But looks like we're all good there. So the sum of all those things together becomes 28,700 of current assets. And then plant, property, and equipment. We have store equipment with some depreciation. I guess maybe if we saw that it was accumulated depreciation equipment, that would have helped us understand that it sells equipment, I guess. So let me find where's my equipment? There we go, store equipment and depreciation. No, we need accumulated depreciation. So what I was mentioning there is this depreciation expense account just says equipment, but when you look at the accumulated depreciation account, it says, the actual related asset account, it says store equipment. So that would kind of tell you a little more. It's not office equipment. It's related to the actual retail store. So 40,500. The accumulated depreciation, again, it's a subtraction, but we don't put negatives in just per the problem. So we take 40,500 minus 2,300 gets us 38,200. And if we add 28,700 plus 38,200, we get 66,900. Let's just check ourselves as we go, make sure we don't mess something up. Okay, that looks good. And then the way that we sort liabilities is, the wording is not liquidity exactly like it is with assets, but it's the liabilities are going to be paid soonest. So basically it always starts with accounts payable. And then what else do we have as far as liabilities go? Unearned revenue, I think, is going to be our next one here. And that was 6,000. And now we need to kind of figure out what, trying to see if I'm missing any other ones here. Okay, so now here we split out the notes payable current portion versus the non-current portion, because the current portion basically is anything that's going to be the portion of our debt that's going to be paid within a year will go in current, and anything beyond a year will be non-current. And so somewhere, okay, yeah, it needs to tell us how to break that out, because in the trial balance, it's all in one account here. And it says the note payable is payable over 9 years in equal annual installments. So if we take I guess we just do it 9 years, it's $9,000. So we're going to pay $1,000 a year. So the amount we're going to pay next year then is $1,000, and then the rest of it is $8,000 to bring us to our total there. So if we add these all up, we get 13,400. This, you don't have to add anything, it's just that one number. And then you take the 13,400 plus 8,000, 21,400. Again, owner's equity is just one number. It's not really something we have to add to get a total, but that's fine. 21,400 plus 45500, 66,900. All right. Oh, that's good. Sorry. Total liabilities and owner's equity equals total assets. So feeling pretty good. That's a good sign. Got it all in there, 100%, and yeah, good to go. So as you can see, these problems are definitely a little more involved, complex, and they just are really more of a breakout, as far as the account classifications go. And we don't just put revenues one category, expenses another, category, assets one category, liabilities. Here we're breaking out current, non-current, sales related stuff. We're calculating gross profit. We're saying we're separating out selling and administrative expenses, so and other types of income and expenses, so on and so forth. So, all right, let's move on to the next problem. So we're almost to the end. So question 13. Okay, so we operate several retail stores, products for a healthy lifestyle, yada, yada, yada. Okay, so now we're just doing a multi-step income statement. So sales revenue is 180,400. And then we need to back out our sales discounts and our sales returns and allowances. So I mentioned this previously. These are contra revenue accounts. So in other words, this is our total amount that we would have been charged, or it's not been charged. This is the amount we charged, for selling our products. But then we had offered some discounts, and some customers, either returned goods or we gave some other kind of allowance for it, basically. So the actual amount that we ended up having as sales after we factor in all the discounts and returns and stuff is 173,000. Oh, sorry, that's the net sales. The subtotal of these two numbers is 7,400. And this is gross profit, I think. Is that what we're trying to get here? Sales. What is this one having us put in? Oh, cost of goods sold. We haven't done that yet. Sorry. Yeah, so we have to factor in our cost of goods sold. And our net sales minus cost of goods sold is how we get our gross profit. So we earned 112,600 after factoring in, the cost of the stuff that we had to buy. And then we'll break out selling and administrative again. And we're doing alphabetical order this time, so that's fine. Store equipment, now we know, that's going to be that's one of the expenses for selling. This gain on sale of equipment, that's going to go down with other. So office salaries and office supplies, that's going to be an administrative expense. Sales, salary, and utilities expense. So let's try to, there's three selling expenses. So depreciation expense will be first. The next one will be not office salaries, sales salaries versus utility expense. So S and U. Okay, so that's, I guess they're in. Are they in alphabetical? C, E, F, G, H. Okay, so I guess we just kind of go top to bottom here because they are in alphabetical order here as well already. That's kind of handy. And I guess they're here too, so that makes it a little easier. But let's go through and actually put the numbers in. So 5790. Sales salary was 31,800. Utilities expense for retail. Let's add these up. I get 43390. Let's check ourselves before we get too far. Okay, we're looking good so far. All right, what else we got here? Insurance expense will be more of an administrative cost. Interest expense we're going to put down with other. We have office salaries, office supplies, and utilities for the office there. And so that was $10,800 for insurance. $37,900 for office staff. Office supplies was $3,100. And utilities for the office was $3,500. So if we add all those together, $55,300. Let's just check ourselves, make sure we didn't do any typos or anything. Okay. So then we get the $433.90 selling expense, $55,300. Admin, add those together, we get $98,690 of total operating expenses. And then we just take our gross profit minus those operating expenses. So I get $13,910. And like we said, let's factor in, we have gain on the sale of equipment and we have some interest expense. So our gain on selling some of our equipment was $4,550. And our interest expense was $780. So $5,330. Oh, I screwed that up. It's 4,550. The gain is a plus, the interest expense is a minus, so really it should be 3,770. This minus that. Okay, so then we get 13,910 plus 3,770 gives us 17,680 as a net income. And all right, we did it all good, 100%, looking good. Cool. A little easier when you don't have to do all the rest of the financials. All right, so let's look at our problem here. So this is our final one, and we're going to be looking at inventory turnover ratio. And what we want to do is calculate the inventory days on hand for both companies. And so when we're talking about the inventory turnover ratio, it's something that we would, you kind of look at to say how many times does your total, like if you buy, on average, if you bought a certain amount of inventory, how many times has that inventory gone to zero, essentially? And so to get that number, we're taking our cost of goods sold divided by average inventory. And then to get the inventory days on hand, we're taking that inventory turnover ratio, and that's the denominator. We take 365 days divided by the inventory turnover ratio. So in this instance, 365 divided by 9.5 for the young radio. Round your answers to the nearest whole number. So I think 38 and 261. So 365 divided by 1.4. Sure we got those. Yeah, so no decimals is basically what it's saying. And yeah, if we knew, so that basically tells us that this company keeps a lot more inventory on hand. They sell inventory at a much slower rate than this company does. This company only has 38, days worth. If they had average sales that they've experienced, for the period that you're looking at previously, like for the last year, for example, if we had the same amount of average inventory and sales and all that, then we would be able to last 38 days if we didn't order any more inventory. Whereas this company has a lot more inventory on hand and they sell it slower or both. And so we would be able to last longer. You don't really want to keeping inventory on hand. Well, that might seem like, oh, these guys, that's great. When you buy inventory, you have to store it and you have to hope you sell it, and all that kind of stuff too. So there's downsides to having a high inventory days on hand number, but you want to have enough. So it's kind of a balance, finding the right number when it comes to that kind of thing. So more of a managerial type decision, managerial accounting class, type of concept, as opposed to our intro to accounting, but good concepts just to kind of think about, The quicker you can have, the less inventory you can keep on hand, kind of the better, basically, like we mentioned, because you have to store that inventory, you got to secure it, you got to watch it, you got to make sure it doesn't get damaged, etc. But you want to have some inventory on hand because you don't want to get caught, without supplies or, not being able to sell your products, basically. So cool. Well, that brings us to the end of this whole session here for the Chapter 9 homework. Hope this was helpful, and I'll see you all in the next video or in class. Thanks, everybody.